All right, good morning. So I'll kind of spin off of what Paul was talking about in terms of some of the crop prices, things of that nature. Remember when I kind of do my presentations, my target audience a lot of times is producers, and the things I relate back to you too are what they're telling me and what we're seeing out there right now. Okay, it's obviously a very difficult situation given the way the markets have acted over the last basically 6-7 months here. So let's just kind of get right into things here very, very quickly. First off, excuse me, went too far. Corn prices, we've been on a bit of a slippery slope basically since we put those June highs in, as we were really focused on the weather. And that really put a lot of farmers behind the eight ball. We had weather, very, very difficult. Crop was very, very questionable in terms of what we had. So a lot of guys sat on their hands, did not sell grain because just didn't know what their production was going to be. As Paul mentioned too, last year's corn and soybean crop was one of the most expensive crops out there that we've ever planted because of the cost of inputs, due to inflation, due to just shortages, whatever came into play. And now we're starting to see that. Obviously, now we've gone on the slippery slope. Prices did pop a little bit higher today, but guess what? We are now reversing to the downside today. So it's making me a little nervous that we've got more room for this market to go. Soybeans have been a little bit more reflective of the tighter supply, but now as we're getting through the South American weather concerns, obviously, we can see what's happening in terms of price here. You look at I think prices are reflecting the current market conditions. What worries me the most is the amount of air, as I call it, underneath these charts if we break these last key support levels. You can kind of see corn has already broken through that $5 barrier, $4.50 barrier. Now we're looking at targeting maybe the low fours. We'll see if that can hold true or not. There's some things that have to come together here as we go forward. Soybeans, to me, that market has got a lot of air underneath of it if we kind of break through this key spot here, this $12 window. Again, making producers very, very nervous. We talk about what we call the market cycle of emotions in terms of how producers feel. Obviously, when we were in June, they loved the prices. Things were great. Okay, but that's when we had our maximum risk. Unfortunately, because of concerns regarding the crop, cost, whatever, a lot of guys didn't put the risk in, and now they're feeling it. Now we're in this fear, desperation, panic mode as we're like, hey, I'm not going to be able to pay my bills. I still got corn to sell. Prices don't look like they're coming out of things. So they're getting very, very anxious. To me, we have to hit, unfortunately, this capitulation, hopelessness where things throw up their hands. That's when I think we hit to our market bottoms. I don't think we're there yet, unfortunately, just given the whole scheme of things. So let's just quickly look at 2024 going forward. Supply picture, I'll touch on that. Where's the demand? I'm going to spend a little more time there. Some of the macro things that we're seeing in the economic side, obviously I'm not going to get into in depth as our economists will. Potential that South America crop, because that's been the buzz all winter, what's happening there, and then basically a little bit of 2024 weather. So first off, our growing supply picture, very, very unique year for producers. 177.3 bushels per acre is the USDA number that came out. Big change in terms of raising that yield up off the last report. Really kind of shocked the market. USDA made some demand adjustments, so we really didn't overflow the supply side, okay, but it did go up. But at the same time, you look where we were the last 2 years prior, we just got overabundance of corn. And that was the thing I heard from producers as we got to the second half of harvest. They were just amazed how well those crops yielded with the little rainfall that we had. Again, like Paul said, it came down to your soil type when the rain came. And right now, we've just got this pile of corn that we need to find a home for. We don't have it at this time frame. Soybeans obviously is still reflective supply, but again, another bump up in yield. A little bit demand concerns on soybeans. I'll touch that in a moment. But again, now we're got to carry out pushing back to that 300 million bushel level, which is still relatively tight. But at the same time, the trend is not in the right direction. Stocks use is a measure of how much supply is available. Corn, we're about 14.6%, soybeans 6.7%. But you can see the upward trend in both of those as supplies continue to tighten or continue to grow. The biggest thing I look at, this is a very busy chart. That 14.6%, if you see the red line, that is the potential range of prices given that stocks used, which is that available supply. So we're looking at a range 450 down to 350 in terms of price window. Now we throw just cost of production, keeps things to the top end of that, but it wouldn't surprise me we see prices fall in that area given the supply picture. Obviously, things can change very, very quickly given the events of the world. On the soybean side, $12 to $10 that stocks to use. Okay, it could be a potential landing zone as we get into prices for the rest of the year. But we really have to watch what next year's production gives us. On the global scale, if you look at soybean stocks, corn stocks, again, trending to the upside, probably going to be influenced by what we're going to see out of South America, as well as that jump in U.S. production. On the soybean side, obviously the South American production is a big factor, add into the growth that we saw in our crops over the last handful of months. Cash markets, one thing we focus on. You can see the difference just reflecting the supply. This is corn basis on the green line last year, obviously trending above 5-year averages. This year, we're towards the bottom of that range. Again, just reflecting the supply that we see. Soybeans, very, very similar. Last year, we were above 5-year averages. This year, we're down below, again, with some concerns. I'm going to get into the demand side of the equation now. That's where really is the talk in this marketplace. First off, export front, export targets. Corn's actually off to a pretty good start, up 36% from last year. But unfortunately, if you look at that green line, last year was pretty awful. So the 5-year average is the purple. We're challenging that 5-year average. We continue to need to see demand. Fortunately, we're a little concerned where that's going in the longer term. Soybeans, not a good year going so far at this time frame. Again, 18% down from last year. Last year was a pretty good year. That was due to the tighter supplies out of South America or Brazil due to their crop, as well as Argentina. Brought that export demand here. They've got those supplies potentially coming. Changes the whole dynamic. We look at the China factor, and I want to spend a little time on this. In my interview this morning, I talked about this a little bit too in terms of the radio show. Let's go look at the corn side of the equation. That's where everybody is waiting for China to show up. Okay, typically, within the exceptions of the last couple of years, they do not buy a lot of U.S. corn. It came out of the Ukraine. Then the United States jumped in for basically about 3 straight years. Now they're getting it from Brazil. So that's the concern point, is that Chinese demand is not going to be here. We can see 1.758 million metric tons. You can see for the 2 previous years, 21, 22, okay, 2021, even 22, 23, how much more there was in terms of demand. On the soybean side, just again, overall competition globally, again, running well below previous year's levels in terms of that Chinese demand that comes into play. Tied to either geopolitical, tied to just markets in general. Okay, I do think there is some retaliation for some of the geopolitical things going on that's keeping China out of our market. But at the same time, they are still the shrewdest marketers in the world. They buy value. The value is not in the United States prices right now. Classic example, look at the corn side of the equation. This is Brazil's corn exports. Okay, monster jump after their strong crop this last season. Record levels of corn exports, 29% or 30% of that basically went to China. We've seen an explosion in movement the last 4 months, September, October, November, December. We've seen a high amount of corn move to China from Brazil. That's a window that we're counting on that business to be here. If you go look at just over the history of time frame, the impact of Brazil, 40% of Brazilian corn imports, okay, or corn from that China brought in came from Brazil, obviously replacing a major portion that they would buy from us. So that's the question. If they do come into our marketplace, we'll see if that does occur. On the soybean side, again, the Brazilian current export numbers are extremely high compared to history. 73% of all the bushels that they ship out have gone to China in terms of soybean exports. If you go look at, again, this is the combination, soybean meal, and corn. In terms of Brazilian exports, you can see the explosion in the Brazilian shipments, okay? Again, strong production, lower prices, things of that nature really come into play. And most of that, again, is that Chinese business. But again, December, those numbers coming in now, 8th consecutive monthly record of combined corn, soybean, and soybean meal exports to China. So that continues to be the big question. And the demand side, does that come around? Right now, it doesn't feel that way. We'll talk a little bit more about their production in just a moment. Other factors domestically, what's key? Ethanol has been fairly solid this year, okay? But we are concerned about fuel consumption. We've seen some of those rates come down recently. That directly relates to the ethanol side. Again, soybean oil is the big talk in the soybean industry. We are replacing a lot of our lost soybean demand with domestic demand, and that's very much tied to crude oil prices, diesel prices. And you can see we just had record crush numbers released for December. So there is some optimism that we could still see that demand stay there. Looking on the macro side of things, just going to put up a couple different trends that I've been kind of noticing. Obviously, first off, US dollar index and commodity index. Okay, everybody always talks about strong dollar, bad commodity prices, weak dollar, good commodity prices. Realistically, probably tied to inflation. I'll show that in just a moment. The recent run between the strength in the dollar and the tide of commodities have been pretty much hand in hand. Okay, again, I think that's more inflation tied. Now, as inflation's coming under control per se, now maybe we're starting to see that deviation where the stronger dollar could impact commodity prices again. One other side of it too, you can see the equity markets. They were working fairly well together, but now that divergence is coming as money reflecting maybe tight changes in policy. We're seeing it move more to the equity side, weighing on the commodity side. The commodity side has obviously been impacted by the anti-inflation play. As funds and managed money have moved away from their positions in the ags, and I'll show that in just a moment, reflecting again, hey, we want to be in the equity markets where the returns are, against those deflationary type plays in the commodity sector. So again, just showing that relationship. This is the inflation chart, basically consumer price index. You can see the spike we had after the COVID 2020 kind of washout. Again, notice the reflection in the Goldman Sachs Commodity Index. Now, that is also very driven by energy prices in terms of the main focus there, but it's a very good pattern, as we can see, as inflation's come down, so as the commodity indexes as well. Again, that anti-inflation mentality in terms of the commodity prices. So that brings me to the funds and the flow of money. Probably one of the most hated conversations you have with producers is about money flow. Okay, right now, probably the biggest weakness in our prices is basically how the money is pushing this market to the downside because they have no reason to get out of a short position at this time frame. So if you take a look at it, here's basically corn futures. Again, we're down about 260,000 short contracts. In other words, they take their longs, their shorts, their options, compile them together, get a net number, which is 260,000 negative. As you can see, it's almost down to the COVID lows actually below the COVID lows, looking to challenge some of the lowest levels in multiple years. Again, that is a direct reflection to our prices. Soybeans, we've seen the hard sell-off now as this Brazilian weather has seemed to have straightened out, and now they're pushing that to a negative position. And again, just watching the market prices here makes me fearful they got some room to push this even further. On the ag sector in general, this is a little bit more on the big picture side, but this is over the last 24 months. The black line is the net position of all agricultural contracts. As you can see, they have pushed this now. Well, this was about a week ago. This has actually grown some since then. 490,000 contracts short across the entire ag complex. Again, that's going back to the maximum bearishness we had during the COVID-19 washout and continuing. Again, a combination of inflation, supplies, demand. Okay, one thing I just think on the global scale, countries just don't have the money to go spend. Interest rates are a factor in that. It's a lot more hand-to-mouth purchases in terms of the export side. I think Paul mentioned it, or somebody mentioned if it wasn't for Mexico, we'd have really issues on the corn side. We aren't seeing those traditional buyers besides China, but Japan, okay, South Korea, Vietnam, Philippines, they're more hand-to-mouth in their purchases until those purchases are fading according to what we've seen in the past. Last couple slides, just quick touch on weather. Obviously, El Nino has been a major factor in Brazil. Okay, we can see the dryness that they've dealt with, but now weather forecasts have seemed to have get through early beans harvested but caused issues. But some of the later beans are coming along. Now the weather's improving for a potentially pretty good corn crop, even though the acres could be down. U.S., we do have still a problem spot here in the middle of the country, so we'll have to continue to watch that. I got to pick this up. I'm getting through speed. But summer weather right now is looking relatively favorable, but obviously that can change in a heartbeat. Last thing on that South American crop. You can see the damage according to the vegetative indexes. But again, this is improving. We're still looking at strong South American production. Let's focus on the orange one. With the last USDA report, corn production, given the strength in Argentina, we could be looking at another plus 11 million metric tons or 430 million bushels than last year. Soybeans, given the current numbers, about 800 million bushels more than last year. So we'll have to see how that plays out. Now that soybean number is coming down, I still think for Brazil, but that's still going to be a question mark going forward. So what am I telling producers? This is our last slide, just going through the information. Again, current situation is difficult, But the supplies, because the supplies softer tone, we want to keep balance in our marketing plan. Get control of those bushels at risk. I've been doing a lot of that lately. We got bushels on price. We're getting floors underneath of them. Just protect here. Let's hope we're wrong. Okay, in that regard, stay disciplined. Sell it when you hit your targets. Okay, don't use the hope strategy that we can go higher. Historical value might come into play, that things could get cheap and we could get on top of this market a little bit. Producers, again, need to measure that risk of doing nothing versus the cost of marketing tools and strategies, because things could get a lot worse. And right now we're already talking about 25. This trend could continue, so we need to make sure we're preparing forward. So with that, thank you for your time. Have yourself a great afternoon.